Hey everyone, welcome in to another daily editorial here on the KE Report. We're chatting with Jordan Roy-Byrne, founder and editor of The Daily Gold. Now, Jordan, one theme that seems pretty prevalent in the precious metals is everyone watching gold and around that 1675, even up to 1700 level, with a lot of commentators that we've had, especially a lot of generalists, saying odds are gold is going to break that 1675 level and head down to, we're getting numbers in the 1500s, even numbers in the 1400s. Jordan, what's your takeaway from this when we see seemingly everybody saying that gold's going to break down and going to continue lower?
Well, I mean, my takeaway from that, and also, I mean, that's kind of piquing my interest. And I think people saying they're a contrarian is really overplayed because if you're going to be a contrarian, you have to be right. And just being contrarian all the time, you're going to be wrong most of the time. But it piques my contrarian interest a little bit. And that's not a word I've used in any updates in, probably a long time. Again, because I think it's overplayed. But hearing all these things and seeing sentiment all on the same side. And last week on last Thursday, 71% of GDX made a new 52-week low. And for GDXJ, it was pretty high. It was in the 50s. But if we're looking at 71% of GDX, I'm just looking at the chart. And the last time there was that happened was you had something towards the end of 2014 where you had, I think, 80% or so made a new low. And, that wasn't quite the end of the bear market. You also had this happen a couple times in 2013. But, more recently at the COVID crash low, we had a similar spike. We had a similar spike in the summer of 2018. If I'm looking at all the indicators right now, the percentage of stocks that have closed above various moving averages, and if you smooth it with a 10 or 20-day moving average, those are very, almost near zero. There's one indicator on stock charts, percentage of GDX stocks that are in a golden cross. That's down to zero. The last time that was at zero was August, September of 2018, where we had a significant bottom. So this is a very interesting time. And I was telling someone yesterday, I mean, I don't think the Fed's going to shift course immediately, but I mean, we're really close to that point where, I shouldn't say we're really close, but the Fed shifting course, I mean, it can slowly come to that point, or it's something that can happen almost suddenly or instantly. And I think a lot of people are not thinking about September being the last hike. I mean, I know I've been way too early and way too aggressive in thinking the Fed's going to shift. I will admit that. But still, we have another 60 days until the November meeting. And if we just look at what's been happening in markets, we look at economic data, we look at how the dollar's trending. I don't think they're going to be able to make it another 60 days without something going wrong and them having to shift policy. And I mean, if that were to happen, like if that were to happen tomorrow, then I mean, that's basically it for this decline in precious metals. And then everybody would be completely on the wrong side based on sentiment. So I think we have to be careful about getting too bearish. And I mean, obviously, I'm aware of the technicals and the fact that if gold breaks 1675, it's going to go to 1600 probably the mid to upper 1500s at least. You would have to think, but who knows? You could get a break below. Maybe it goes to the low 1600s, but it becomes a false break because you get a violent rebound because something happens and the Fed has to shift. So I just think that people have to be careful about getting too bearish, especially people that were bullish for a while. And, now we're seeing the miners are down so much and bulls are now saying that, the market's going to break and we're having a crash, we're going to have a crash. I mean, it's possible that could happen, but, and by the way, this is a completely different setup compared to 2013, which now a lot of people seem to be looking at that side. So I just think that we need to be careful about getting too bearish, especially when breadth indicators are completely blown out on the downside. Gold's outperforming the stock market. Gold's starting to outperform commodities, and then Fed policy. I mean, it's really possible that September will be the last hike. So I think when you consider all these factors, you don't want to get too bearish and at least too certain that the market's going to break and we're going to have this huge dump for another year.
Well, Jordan, I think those are some cogent comments to consider because everybody is on the bearish side of the boat. You brought up the 2013, a lot of people pointing to that. Maybe we'll just touch on that again, just as to why it's a different setup. If people think back to 2011, the last peak in the last gold cycle, it really ran hard most of that decade, and especially from that 2009 to 2011, that's when it got to a mania stage in the precious metals and gold, silver, and the mining stocks. And it started correcting in late 2011, 2012, and it kind of did a sideways channel like we've seen the last 2 years up until the middle of 2013. And then it really took a swan dive down. And we've had some technical analysis, not just here, but just out in the marketplace, suggesting we could be set up for 2 more years of downside in the precious metals. And that while things seem low now, they could have still had a lot lower. And some of that from the fundamental side would tie into a stock market crash. But some of it is that even though the mining stocks are beat up, one guy that had an article out that a lot of people were posting on our side over the weekend suggested they could still drop another 50% from where they're at now. So maybe just outline why you think it's a different setup now than it was at that period of time and why that's maybe not as likely to play out.
Well, the macro fundamentals are completely different. If we look at, and by the way, I haven't seen any, people who are making these predictions, I haven't seen anything about, gold outperforming the stock market or anything. If you look at the macro fundamentals of the macro market situation, I mean, you pointed out the breakdown in 2013, that came after you had a real secular bull market in precious metals and hard assets as well. So there was a lot of people invested in the sector compared to today, which there's far fewer people left in the sector. So I'm not saying gold can't, decline to the 1500s and break that support, but there's much less investors in this sector than there were at that point in time. Secondly, and this is probably the most important point, gold was crashing in real terms right before it started to crash in early 2013. So gold against the S&P 500 was already diving before the gold market itself dove in nominal terms. So that's completely different now. And now we have gold outperforming the S&P 500. It has been outperforming the S&P. That ratio actually bottomed right around the time the S&P 500 peaked. We saw a very similar thing in the 99 to 2001 bottom, where that ratio was basically basing and bottoming around the time the S&P peaked in March of 2000. So there's that to consider. In addition, the stock market was, at the time gold was crashing in early 2013, the stock market was only months away from breaking out from a 13-year base. So the stock market was at the same level it was basically 12 or 13 years prior, whereas the gold market was well above where it was 11, 12 years, 13 years prior. It was in the low 200s or 300 or whatever, and this time it was 1500, 1600. So it was way above where it was 11, 12 years prior. Now it's the complete opposite scenario where you have gold has a super bullish base that it's trading below. Gold is at the same price it was basically 11, 12 years ago. And the stock market is the one that's been in a secular bull market for over a decade. You go back to 2012, 2013, I mean, the valuations on the stock market, the CAPE ratio was around 20. I mean, it has come down in recent months, but it's still, way, way below where it was back then. And then you look at the economy. We weren't going into a recession then. I mean, if you look at all the economic indicators, yeah, they weren't that strong in 2013, but compared to now, you basically have many things flashing warning signs that there's going to be a recession. You have the dollar has already gone through the roof. Dollar, I think in the early 2013, I think it was trading in the low 80s. Now it's much, much higher. So what happened in 2013, I mean, that was a breakdown at the end or right after a secular bull market in precious metals. What we're seeing now in the big picture is far more like what happened around the secular lows that we had, 1969, 1970, and also 2000, 2001. Like if you look at these ratio charts, if you look at various precious metals ratios against the stock market, now they look most similar to how they looked again, right around 2000 and around the 1969 to 1970 period. So those are the best comparisons for what's happening now. It's not 2013, even though there's a similar look on the chart. And I mean, it is possible gold could break that support, and you don't get the secular bottom until after gold breaks that support. I mean, that is possible, but I don't think that you're going to make it like it's going to take another 2 years for gold to make a bottom. I mean, that's just ridiculous considering in that time you're definitely going to see rate cuts. I mean, if you look at every soft landing basically except one, the Fed had to cut rates. The one time there wasn't a soft landing was 2016, where the Fed had to stop. They did one rate cut and they had to basically stop for a year. So aside from that, every soft landing, the Fed's cut rates. Every recession, the Fed's cut rates. So at some point, probably in the next 12 months, they're going to have to start cutting rates. So when you look at all these factors, it's just there's nothing that points to this being like 2013 and we're going to have a bear market for another 2 years. There's nothing that points to that other than, well, you look at the gold chart and it does look kind of similar if it breaks support.
So Jordan, you're encouraged by the way gold has performed compared to the S&P. What about the underlying gold stocks though? Because it's a almost completely different chart in terms of GDX to the S&P. In terms of GDX, is just drastically underperformed.
You're saying it's completely different to 2013?
No, at our current time, the way gold has performed to the S&P has been drastically different than the way GDX has. GDX has completely underperformed the S&P.
Over what time period?
Just recently. Look at the chart right now. S&P to GDX ratio is breaking out to all-time highs, whereas gold to S&P, very different scenario. Why have the gold stocks underperformed the S&P so much if gold has done so well?
Well, I mean, gold hasn't done well. I'm just pointing out in real terms, gold against the S&P, I think it's above the 200-day moving average, maybe a little bit. But my point is it's well above where it was when it bottomed at the end of 2021. And I just pulled up a GDX against the S&P ratio. And yeah, I mean, it's lower than that low, but not by that much. And the problem with gold stocks is that the margins, 2 years ago, if your all-in cost of production was $900, $1,000 an ounce, now it's $1,300 or so compared to, now you're selling for $1,700 an ounce when it was $2,050 an ounce a couple years ago. So the margins have been hit significantly. So if we look at what's happened over the last, 9 to 12 months or so, yeah, the ratio went up. Now it's come down. It's, broken a little bit below that support. But if you look at what happened, like if you go to the end of 2012, GDX against the S&P is like a straight line down. So, that's another difference there. But to me, gold is more. I mean, it's really the most important variable as far as precious metals. And I'll just throw in with silver. Silver looks quite a bit like it did coming into the secular low in 1970 and 2000. So even though it's broken down, it looks very similar to that. So that's just my larger point, is that everything I'm looking at is pointing more to a secular low than the start of a huge breakdown, 2013 style. I mean, again, that came after a secular bull market. We haven't been in a secular bull market. That was 12 or 13 years. And if someone tries to say, oh, well, we've been in a bull market for 4 or 5 years. Yeah, okay, but look at the stock market in those 5 years versus the stock market before 2013. It's completely different.
Okay, Jordan, look, a little bit of optimism there. For the precious metals bugs, look, it's been tough, but again, it's been tough for investors in all kinds of different sectors. Who knows? Hopefully, this is showing that the sector is completely washed out and sentiment will change and investors will start to come into the sector. You usually do see completely washed out sentiment at sector lows. However, the worry is sentiment can remain washed out for quite a while and stocks can continue to drift, especially when they start running out of money. We'll recap all this next week, though, Jordan, hopefully in a different environment as we get some more news or more data to come out. But again, a lot is the same in these markets as it has been pressured to the downside. Jordan, thank you for your time. We'll chat again next week. Have a great rest of your week.